guys, welcome back after the exam. I know you're tired out. It is a long academic year. We got to find a way to keep our foot on the gas pedal, especially during the last quarter of the semester, which is on some tougher topics. So I'm going to share my screen and get started. Remember that I am in my office hours every morning. You guys can always stop by there if you have any questions. And if that time doesn't work with your schedule, I'm happy to Zoom at another time. So here's our agenda. We are in the liability section of the balance sheet. So again, if you think about how the class was structured, they covered some topics on the income statement, but after that, we've been going line item by line item down the balance sheet. So we've covered all the assets, we've covered the current liabilities, and that's where we left off. Now we're on the long-term liabilities, and there's two basic types of long-term liabilities. One we'll tackle today, and the next one we'll tackle at our next class. So today we're talking about bonds, specifically bonds payable. So what I hope during today's lecture is we get a good understanding of what are they. We'll get a good understanding of how they work. We'll talk a little bit about the pricing of bonds, but that's more of an advanced topic. It's in your appendix, and we will not be covering the appendix. I will be talking in general terms about how bonds are priced, but I will not ask you guys to do any of the pricing calculations. We'll talk specifically today about the issuance and why bonds often issue at an amount other than their par or their face value. We'll talk about interest payments, how to compute them. And then I think probably the more difficult topic, at least in theory for students to understand, is the amortization of discounts and premiums. We'll talk about what those are, and we're going to learn the easy way to amortize. It's very similar to straight line depreciation, but we're going to call it straight line amortization. Those of you that are accounting majors, I would encourage you to read the appendix that deals with the effective method of interest amortization. That is the one that is GAAP. But because this is a survey class, the author is just going to give you a little taste of what the amortization process does. And then, of course, I always devote a large part of our class time to actually practicing. I also wanted to remind you that a drop date is coming up. Doesn't affect too many of you in here, but if you have just kind of had one of those semesters where you haven't been working up to speed, maybe life came at you and threw circumstances your way that you weren't expecting, there is a drop date coming up. You can check your syllabus for that date. And I will be also sending everybody a reminder about that date. It's not just for our class. It's for any class that maybe you haven't done your best, you've stopped attending even, and you're still on your instructor's roll sheet. So I wanted to remind you about that. The handout does a good job of describing and emphasizing the various journal entries, but I think for today's lecture, we're going to go mostly to the PowerPoint. This is a tough chapter. It is the toughest chapter that we've done so far this semester. At least that's my opinion. I've been warning you guys from the get-go that the hardest part of the semester is the last 3 chapters. So this is a difficult chapter. Chapter 12 is even more difficult. The reason I'm telling you that is not to scare you, but to get your foot on the gas pedal, to maybe put in an extra hour of prep time this week and also next week to help master the material. Okay, so let's take a look at this handout, and then I'm going to jump to the PowerPoints. We're talking about corporations and how they're financed. And there's 2 basic ways where money can come into a corporation. The more common way is through equity financing. And that means the sale or issuance of stock. It could be common stock. It could be preferred stock. This is where a company it could be an initial public offering where they're selling their stock for the first time, or it could be a secondary offering where they're just selling more of their stock. That's the topic of the next chapter, chapter 11. What we're talking about today is debt financing. And you might say, what the heck is debt financing? Debt to us means liabilities. So we are incurring a liability in return for money being loaned to us. So this involves borrowing money from lenders. You could just walk into a bank and borrow money if you needed it. Usually that's for short-term financing. Most companies could not go into the bank and say, you know what, I need a $3 million loan, right? So instead of doing that, they may decide to float a bond. And a bond is a form of a long-term payable. Bonds in general go from 1 year all the way up to 30 years. And it's usually required when a company is looking for a large dollar value of money to be raised. Now, think about it. If I needed $3 million to do a large expansion for my corporation, there's not too many investors out there that have $3 million sitting aside that they're willing to loan you. But there may be lots of people that have maybe $1,000 out there and they're interested in loaning you the money. If you're a good credit risk, they would expect you to pay them interest along the way. And then they would expect you to eventually pay back that principal. That's what a bond is. It's usually sold in denominations of $1,000. They are or can be publicly traded. That means just like you could go into the Wall Street Journal and look up a stock price, you could also go into the Wall Street Journal and you can look up these various corporate bonds. There's also things called corporate bond index funds that if you're interested in the investing realm, you can go look those up. But what we're talking about for the first day in this chapter are these large corporate bonds that are issued in the hopes of the company gathering enough cash, usually to support an expansion or a new product line, or sometimes a relocation to another place. So I think what I want to do right now is I want to stop and I want to go take a couple notes. So I'm going to pull up a Word document because I just want to make sure that you get the what I'm going to call bare basics of a bond down. In fact, that's what I'm going to call this, bare basics of bonds. And I just want to get a couple of facts in here for your notes. The book tends to be wordy and uses lots of definitions. My goal is to try and take that information and break it down into the most simple terms that I think you guys can understand. So I think I'll number these. These are usually large dollars, okay, often in the millions, over long time periods. Let me back up. When I say long time periods, I said they go usually out to 30 years. They're usually, although not always, sold in smaller denominations. So you might have a $3 million bond that is sold in $1,000 increments. Right? Again, there's not too many of us, including me, that have $3 million that I might want to loan a company. That's just not realistic for my financial situation. But I might be able to find $1,000 that I'm willing to loan a company in return for a decent interest rate. And so that's the other thing I want to put on here. The principal is usually, not always, but usually paid back lump sum at the end of the life. Okay, that would be called a term bond. That's what we'll be focusing on today. But the interest is paid out over various periods. Could be annual. That means once a year. But more often than not, we see semi-annual payments. That's going to become really important to us later. And a semi-annual payment means the interest is due every 6 months. So that would be twice a year. I just want to get these basic bond facts into your notes. This is a chapter, by the way. I know some of you have told me, I don't read the book. I just watch the video and I listen to your lectures. Or some people just tell me that they look at the PowerPoint and that's all they need to do. They don't even need to watch the lectures. This is a chapter where you want to take advantage of all the resources available. I would definitely read the book with a highlighter pen. You guys know me, I'd be outlining as I read. That's how I study. Definitely watch the video presentation, which I see that most of you have already done. Take a look at the PowerPoints. We're going to look at some of them today. And then this is one of those chapters where I would do more than less. Remember, what I give you on the homework is the bare basic, the bare minimum that I expect you to be able to do to master the material. A students and some B students will always do more than less. This is one of those chapters where you may have to do a little bit more in order to gain a comprehensive understanding of the material. Let's see, do I want to put anything else up there? So large dollars, long time periods, usually sold in smaller denominations. For example, a $3 million bond, they would sell those in $1,000 increments. Principal is usually paid back lump sum at the end of the life. Okay, this is where I'm going to stop and say you must read the terminology in this chapter. There's lots of different kinds of bonds. We're focusing on the most simple kind called a term bond, and that's where the principal is paid back at the very end of the bond. Okay, interest is paid out though as we go, every so often, could be annual, but usually it's every 6 months. And at the end of the life, the principal must be repaid. Okay, a couple other things. Bonds can be publicly traded, just like stocks. And their prices are usually shown as a percentage of the face. Okay, that's probably enough to get us started. We're going to go to the PowerPoints here in a minute, but let me stop and always give you guys the chance to ask questions. And it could be, if you're in the live class, just unmute yourself and ask. If you are at home watching the recorded lecture and you have a question that comes up, you should be emailing me or coming by my office hours. Of course, we have an embedded tutor that's a resource to you as well. But any questions? Okay. There are some good PowerPoints. We're not going to look at all of them. These are available to you in the modules link. I put the whole PowerPoints in there unedited. For lecture purposes, in the interest of time, I just chose some that I wanted to go over. So this is like just a little schematic, I guess, of what a bond looks like. The issue date is the first day. The maturity date, which is usually years out into the future, is the day that it's due. In the meantime, we make interest payments. And this chapter, which is unlike the other edition of the book, this chapter just shows you bonds from the issuer standpoint, from the one that is getting the money and has promised to pay it back. It used to be in this textbook in an earlier version, they also used to show you bonds from the investing side. Because somebody like me that's getting older, and I've mentioned to you before, I'm 57 years old, somebody like me should start to take my retirement portfolio, the money that I'm setting aside for retirement. And as you get older, you want to move that money from more riskier investments like stocks, eventually over to bonds. Okay, why, you might say? Because if a company should go under, in the order of liquidation preferences, you have creditors way up here at the top of the list, like the people that you owe accounts payable to. Right after them, you have the bondholders. The bondholders are the ones that have a piece of debt where you have a signed document from them saying, we will pay you back your money with interest. They fall way up at the top, near the top of the liquidation ladder. Stock, on the other hand, falls way at the other end, way at the bottom of the liquidation ladder. So the thing that this book doesn't really present to you too well is bonds as an investment. So I can loan corporations money in terms of bonds or a bond increment, maybe one of those 1,000. And as an investor, I'm guaranteed to get those interest payments every 6 months if it's a semi-annual bond. And then I'm assured of getting my money back. You can read more about bonds on the internet. They are rated by different rating agencies. You may have heard of Moody's. That's usually the one that we pay a lot of attention to. So I also want you to think about bonds in the bigger scheme of the chapter, which is it's a great investment tool for those that are looking at guaranteed fixed payments as you move into a fixed income type of situation where maybe you're retiring and you won't have that monthly paycheck coming in. You could structure the bond investments where you may have interest coming in on specified dates during the period. So I did want to at least explain that to you. Any questions so far? All right, your book does do a good job of explaining the advantages and disadvantages of bond financing when they compare it to equity financing. So one of the best advantages is that you don't have to worry about a takeover selling bonds. They do not affect ownership control. Another huge advantage, the interest on bonds is tax deductible. Whereas if you go and sell stock instead of a bond, dividends is not tax deductible for a company. So the interest is a major tax deduction on the tax return. That's an advantage. And bonds can increase return on equity. You'll notice over here, though, that they can also decrease. It depends what you earn, what we call on the spread. In other words, if you can use that bond money to generate a higher rate of return, then you'll have an increase on the return on equity. If you're paying a really high interest rate on your bonds and you're not able to generate that on whatever projects you have going on, that's why it's also listed as a disadvantage. And then I wrote in down here, one of the advantages is that there is a legal obligation. Now, when I put advantage, I was thinking literally on that one from an investing standpoint. So I guess if you're looking at it from an issuer standpoint, that might be actual disadvantage. Okay, what do I mean by that? If I'm a corporation, if I have equity financing, I've issued my stock, I don't have to pay dividends. There is no legal requirement to pay dividends. But if in this chapter, if a corporation is issuing a bond, they have to legally make those periodic interest payments that they've promised to do. So that may be considered a disadvantage. There is a legal obligation for the bond holder, not the bond holder, from the issuing company, there is a legal obligation to pay that interest. From an investor, that's a great thing for me. They're legally obligated to pay me. But from the issuer standpoint, which is what this slide addresses, that would be more of a disadvantage. Okay, we don't see these anymore because everything's electronic, but there is an actual bond certificate, which we call is what they use to float a bond. Another word that I want you familiar with, because I believe that it is on the test, is a bond indenture. That's the contract where the definition of the bond is defined. Most bonds are debenture bonds, which means that they are not collateralized by the assets that the company has. So they're issued on the general good faith of the company. So there's lots of terminologies. That's why you need to read the terminology for both this chapter and the next chapter. Even if you've never really paid attention to the terminology in the chapters, this chapter and the next one, there's lots of new terms, and I would encourage you to spend an hour asking yourself, do I know all the words in the glossary for this chapter? Your smart book has a feature where you can hover over the word and it will tell you what it means. So it's a good way to study those. Questions so far? Okay, as I mentioned, bonds can be publicly traded. And in this case, this is for an IBM bond. What you want to pay attention to is the close. If it's greater than 100%, this bond has been sold at a premium because it sold above the face value. If you would have seen that close at an amount below 100, let's say 96, that means that that bond is trading at a discount. We'll talk more about those terms in just a second. So there's basically 3 journal entries that I think we need to pay attention to. The first one you're going to see on the screen. What journal entry do you make when the bond is issued or when the bond is sold? Okay, we'll talk about that. We'll dive in and we will be doing our own work. So issuance, write that in your notes. You got to know how to do the issuance journal entry. The second journal entry you're going to be responsible for is the interest payment. And when we make the interest payment, you'll see today that we're going to talk about discounts and premiums. When the interest payment comes around, not only are you paying out that cash interest that you promised to those bondholders, you're also going to amortize either a discount or premium. So if those words are foreign to you, that's why we got to read the chapter and watch the video. We'll go over them as part of our lecture, but I'm assuming that there's this certain level of knowledge that you already have from prepping yourself for class. Okay, so first journal entry you see on the screen, got to know the issuance journal entry. The second entry that we'll get to in just a moment, you got to know what happens on the interest payment dates. And then the third journal entry, while you're taking notes and while you're keeping track of these things, the third journal entry that I want you to know is what happens if you have to make an interest accrual, right? And you guys know about interest accrual. These bonds are not always sold on the first day of the year or at the middle of the year on 6/30. Oftentimes they're sold between periods, and so there may be an interest accrual necessary. So write that down. I would consider that a minor journal entry, but you do need to know how to accrue the interest. All right, so in this case, and this never happens, by the way, but it's a textbook. On this date, a company issued the following bonds. The par value, what you'll probably hear me refer to as the face value, it means the same thing, was $100. And the book mentioned that sometimes it takes a year or two to float a bond. Well, what happens in that year or two is interest rates fluctuate, right? Interest rates fluctuate all the time. Anytime you get ready to buy a house or even a car, interest rates fluctuate all the time. So the chances of that 8% that's stamped on that bond being exactly at 8% when the bonds sell is slim to none. And so we need to learn how to adjust the price of the bond based on this stated interest rate. So in this example, which is very unrealistic, the stated bond says 8%, and the market is also saying that the bond should sell at 8%. What that means is there's no premium and there's no discount. We're just selling that bond at exactly 100,000. So here's the journal entry. The company's cash goes up and the company's debt goes up. So remember, bonds payable is a long-term liability. It is a new account that represents the face value of the amount due. Because remember that just like our car payments, if we decide we want to pay our car off early, companies can also decide to pay their bonds off early. So they're never, that's why we don't put the interest as a payable on the books unless the interest is owed from a back date. Okay, so then what happens? Remember, journal entry number 1 was the one we just looked at. This was the issuance. In fact, I'm going to circle that. That's the issuance. And that issuance that they're giving you in this first example is where the market rate exactly matches the stated rate. It never happens in real life, but again, it's a textbook. So that's the easiest example. It's stamped 8%. The market's paying 8%. It's going to sell right at its par. The second journal entry is the interest payment. Okay, in this case, there was no premium or amortization because it sold exactly at the face. So we'll do an easy example first. Every 6 months on this bond, because they made mention that the bond pays interest every 6 months, every 6 months, this company is going to send out interest checks to all the bondholders. Okay, well, we already know how to do interest. Interest is the principal times the rate times the time. So here the principal is that 100,000, that's the face value. The 8% is the stated interest rate. That's what is stamped on that bond when it was first developed. And the time is what people tend to miss. The time is what portion of a year is that bond good for? Well, when I do these calculations, I'll probably write down 6/12 because in my mind, interest rates, I always base it on 12 months in a year. Your book is going to simplify that probably and use a half. But as you guys know from your basic math classes, those are equivalent numbers. So when I do that on my calculator, 100,000, the principal, times the rate of 8%, times the time of 6/12 or half a year, I get 4,000. Every single time we make an interest payment, here's the journal entry. We're going to debit bond interest expense, and we're going to credit cash. Okay, again, this slide assumes no premium or discount. It's a theoretical example. It only happens in textbooks. We'll look at a real live one too. And then the last thing that happens, eventually at the end of the life of the bond, that 100,000 is paid back. And so here's the wrap up. If you're talking about the life cycle of a bond, we have the issuance, that's the starting point, that's when it's born. We have the interest payments that happen over all the periods of the bond. And then we have the payoff on the last day that this bond matures. That's when the payoff of that face value happens. Now, as I mentioned, in real life, remember that it may take a year or two to float a bond. Interest rates are going to change. And so I don't know if you guys are going to be able to see this, but here's the example I use in class. So I have my bond that is stamped, and I don't think that comes in too clearly. It says 8%. Okay, it says stated rate on my bond is 8%. Okay, well, if it takes me a year or two to float this, what happens if outside the Wall Street people are offering 10%? Okay, remember, you're only going to pay 8%. That's what's stated on your bond. That's the legal obligation. And everybody else on there, everybody else on Wall Street is offering 10%. Who's going to stand in your line? And the answer is nobody, because they're going to go next door to someone that has a fairly priced bond at 10%. If yours is only paying 8%, nobody is going to line up at your door to buy a bond unless the price goes down. It would be the same logic as if you were selling a car and you offered a price for this car that nobody was interested in because there were other cars of the same make, same model, same condition going out there for less. So what would you do if you were stuck with this car and you had asked an inflated price? You would, through the market supply demand theory, you drop the price until finally you had some interest in the car. The bond market, I'm trying to oversimplify this, the bond market works the same way. If nobody's going to stand in your line to buy an 8% stated interest rate because everybody else on Wall Street's offering 10%, the price is going to drop and you're not going to be able to get $100,000 on your bond. You may get something like 98% on your bond, let's say. And so in that case, if you're only getting 98,000 in cash, you would have what we call a discount. You're going to see that happen in some of these other slides. So it's market effects that cause the what we call the market rate or the effective interest rate to go up and down. It's market driven. So the bond prices will automatically adjust. So let's take a look at this next slide. I think that you guys should print out this slide or somehow get this into your notes. This is a really important slide. So if you have a contract rate and you compare it to the market rate, here's what's going to happen. In our case, that one that I just gave you, my example, where our contract rate was 8%, but the market rate was 10%, that's going to cause the cost of that bond to drop, and that bond is going to sell at a discount. What does that mean? It means that the company gets less dollars than the face. Okay, let me stop because this is probably the toughest part of the chapter, comprehending what this discount or premium is. Any questions on that so far? Okay, let me try another example then. Now I have this bond that is still a contract rate of 8%, right? Again, it took a year or two to float this bond, but on that bond, it's stamped, I promise to pay you 8%. Well, now what happens in the market outside because of interest rate drops and so forth? Wall Street is only going to pay 6%. Right? So now you have a bond that's paying more interest than everybody else outside. And so now you're going to have a bunch of people standing in line to buy your bond because, again, you're paying 8%. You promised to pay 8%, but Wall Street out there is only offering 6%. So it would be the same thing with that car, right? If you're willing to sell this car and you ask a decent price and all of a sudden you get 20 people at your door, what are you going to do? You're going to start saying, okay, I underpriced my car. I need to get more money. You're going to be able to get more money for that car because the demand is greater for that. That's the example of a premium. So our little example here, the contract rate was 8%, just like before, but because of external forces, the market has dropped to 6%. Now everybody's going to stand in your line. You're going to be able to sell it at a premium. Bond discounts and premiums are recorded initially as a liability. So the bond discount is a liability account, but it's a special kind. It's a contra liability account. So that means it has a debit balance. Okay, premiums, on the other hand, and I don't want you guys to worry about this terminology because you may have never heard it before. It's called an adjunct, or the word I like is an add-on liability. It has a normal credit balance, and the whole purpose for having these two accounts is to adjust your bond to the market. So I think probably the best way to do this is jump in and try one, but let me go over just a couple more slides and definitely let me stop and take any questions. Okay, so we know that because of supply and demand, because of market-driven forces, bonds will rarely, if ever, sell exactly at face, except in a textbook. So in this case, we have a $100,000 bond, but because of market forces, that is going to be issued below the market. Why would that be? Again, our bond is stamped 8, but Wall Street out there is offering more than we are. So the market's way of adjusting the rate is to get less money for that bond up front. Okay, this is what happens in the market. So on this example, you're actually getting $96,400 in cash, but you have to pay $100,000 back at the end of its life. In the meantime, you got to make those guaranteed 8% interest payments. So this is a more realistic example. Let's see what this would look like. Here's the journal entry for issuance. Okay, as I mentioned, you didn't get the full amount because of the market factors. You got $96,400, but you owe, by legal definition, you have a stamped signed document promising to pay back $100,000 at the end of its life. So that bonds payable is going to go on at the face or the par value. The difference to balance it out is going to be either a discount or a premium. As you see here, the discount has a debit balance. The premium would have a credit balance. Okay, what are we going to do with that discount or premium? Because GAAP says you need to match revenues with expenses, you don't take that interest expense hit all at once. Instead, you're going to spread out that discount or premium over the life of the bond by amortizing. That word might be new to you. Amortizing is a fancy word for depreciation. It's just that it's not a physical asset we're depreciating here. It's this discount, but think of it kind of as depreciation. We're going to take that $3,600 and we're going to charge it out over the life of the bond. I can't remember how many years this bond was. We'll probably see it on the next screen. But if this were let's say it's a 2-year bond, for example, that means there's going to be 4 interest payments. You would take $3,600 and you would divide by the number of interest payments. And that's how much you would charge out to interest expense over the life. Let's look at the next slide and they'll tell us exactly what it was. Okay, so I probably have to make this bigger here. So here is the journal entry that most students struggle with right here. It's probably the most difficult one. There's 2 things going on here. There is the cash interest, okay, that we looked at before. That was the principal times the rate times the time. We did that earlier on a previous slide. In addition to that, there's an amortization of that bond discount. So this had 4 interest payments. That's a surprise to me. I didn't look ahead, but it was what we had suggested it was. 4 interest payments. So $3,600 divided by 4 payments means every time we make an interest payment, we are going to amortize $900 of that discount. So what are we doing? We're taking that discount, which is an adjustment to the interest expense that happened because of market factors, and we're going to spread it out over the life. Every time we make an interest payment, we're going to amortize $900 of that premium. So because that discount, remember what the discount account looks like. It looks like this. It is a contra liability. So it has a normal debit balance. Remember, there's $3,600 in there. Every time we make an interest payment, we're going to take $900 of it off. And you'll notice that by the time this bond reaches maturity, the goal is eventually to have 0 left in that discount account. That's the way we adjust the market factors on our accounting books. That is probably, that journal entry right there is probably the one that causes the most confusion. To add to that, Connect does this in 1 journal entry. I personally would have done it in 2. I would have done the cash interest expense of $4,000. So I would have had a bond interest expense for $4,000 and a cash credit for $4,000. That would have been my first entry. My second entry would have been just the discount by itself. It would have said bond interest discount, debit $900, and credit discount on bonds payable, credit $900. Connect lumps those 2 together and does 1 journal entry. So what you might want to try as you're studying for this chapter, you might on a piece of paper want to write out both journal entries, the cash journal entry and the amortization of the discount and premium, and then net them together. That might be the better way to go about this so that you understand what Connect is doing here. Not the best way, in my opinion, to show it, but we kind of have to live in these circumstances right now with what Connect has. If you guys were in my traditional classroom and you were taking a paper exam, I would tell you, do it any way you want. Do it in 1 lump sum journal entry or do it in 2 separate journal entries. I would grade either. But with Connect, we're stuck with these drop-down boxes that we have to fill in. So once again, just another reminder, when you guys do your homework, some of you are shortcutting the learning process. You're going directly into Connect and you're just filling in those drop-down boxes. The better way to do it, and you'll thank me when you get to the university, the better way to do it is to open up Connect, write out all the facts on a piece of paper, draft your solution on paper, and then enter those into what I call the Connect accuracy checker to make sure that you got it right. Let me stop because that is confusing and see if there's any questions.
Yes, Professor.
Sure.
From my understanding, the interest paid to the investor never really changes from the principal amount. It's just you have to account for the expense incurred in issuing a bond either above or below market value, right?
Exactly. The cash interest paid to the investor is a static fixed amount. This is really an accounting adjustment because we have this matching principle. It says we have to match these revenues with the expenses in the same period. This is the way of taking that market adjustment on the books and spreading it out over the life of the bond. Exactly right. Great question, Thamira. Anything else? All right, I'm not a big fan of these amortization tables, but your author is. Let me describe to you what this does. He schedules out all 4 interest payments. He starts off with 0 and he goes to 4. He lists the date. He has an unamortized discount. Remember, we started off with $3,600. I'm going to add another little column in here to make this a little bit more understandable. The interest amortization, I'm going to put, remember, was $900 each and every time. So what he does here is he just keeps track of the unamortized discount each time. And again, it has to reach 0 by the time the bond is paid out. Now, when you're looking at this carrying value, that's another word you need to look up in your book. When you're looking at this bond carrying value, it's calculated as face value or par is another word, minus the discount. Okay, so in this case, before they do any amortization, that carrying value is 100,000 less the 3,600 that's sitting in the discount account. So when we start, the carrying value is 96.4. Eventually, that has to make its way up to the face, the $100,000. And so that's what that amortization table shows. Will you have to do one on a test? Honestly, I'm not sure. I haven't created the test. I'll tell you when I get closer to it. I think it's important to understand the concept of what's going on, but I don't think, because we're using the straight line method, I don't think a table is 100% necessary because we're doing the same amount each and every month. By the way, since we're on the topic, when we have a premium, the carrying value on a premium would be the face plus the premium. It's the opposite of a discount. It'd be the face plus the premium. So that's the last thing we need to look at. What happens when we have a premium? Exactly the opposite happens. So a premium, let me make this smaller again, is because, again, your bond is not priced properly. So on our bond now, we're using a stated rate. He just switched it up. Why, I don't know. But now he's saying the stated interest rate on that bond is 12%. But the market is only offering, the Wall Street's out there is only offering to pay 10%. Now think of that new car example. You're going to have everyone in your line because your bond's paying more. So the investors are going to be standing in your line, which will cause the market to go up. That is an example of a premium. In this case, you're going to get, based on the price quoted here, you're going to get 103,600 on day one. You're still going to have to pay back the 100,000 at the end of the life. That doesn't change. What does change now is you're going to have a $3,600 premium now that sits in this credit account called premium, 3,600. And once again, our goal is to amortize it over the life. So if you take 3,600 and once again, you divide by 4, now you're going to get a $900 adjustment that happens every single time you make an interest payment. But in this case, when there's a premium and we're going to debit that premium to make it go down for 900, the credit here is the weird part. The credit is to interest expense. Okay, now some of you, like me, when I was sitting in your seats, might be thinking, whoa, you've always told us that expenses are always debited. You never credit an expense. This is one of those rare examples where the reason we're decreasing the expense is because the interest expense is overstated right now. So we got more money than the $100,000. We got to take that $3,600, I'll call it market differential. Your book's going to call it a premium. And we have to spread it out over the life. So what that's going to wind up doing is pulling down the total interest expense over the life of the bond. Okay. And again, this is not easy. By far, I think this is the hardest topic we've talked about in this class. And so accordingly, you're going to have to devote that extra half an hour, hour's worth of study time. I would say more than an hour. Here's why. It may take you an hour just to get through the terminology in this chapter, let alone the accounting journal entries that we're going to be doing. So let me stop. And I'm going to show you the journal entry for that. That's just my chicken scratching and what's going on. And don't forget, of course, we still have that interest payment. The cash interest payment doesn't vary. Let me write that down here. This is why I would do it in two. Interest expense and cash was $4,000. This makes sense to me, the two different journal entries. Unfortunately, your author is going to cram them in. They're going to combine them into one. And so if you look at this, interest expense in the one combined journal entry is going to be the 4,000 less the 900. Let's go look. So here it is, the 4,000 less that amount, whatever that amount was. This is the issuance. Let me back up. This is the issuance. So when they issued this, they got 103,600 in cash. They recorded a premium, which is that adjunct or add-on liability account. And they credited, as always, the bonds payable for the face. The one that is challenging is this one. Okay, this is where they, let's see, what is this one? Premium carrying value. I'm not even interested in that one. I want to show you the interest one. That's the one that confuses everybody. Here is those two journal entries now combined into one, where we have bond interest expense, which is that amount less the premium, and the credit to cash, of course, is going to be for the cash stated interest rate. It looks like they changed the interest rate on this one. That 4,000 that I showed you earlier wouldn't be applicable because they changed the interest rate on that one, which also drives me crazy. I would have kept the stamped rate at one amount, and I would have done an example with a premium, and with the discount, I would have kept the stated amount the same so that you could see the difference. But again, a difference in presentation. Okay, again, the whole goal of this is to get that premium from what it's sitting at right now, 3,600, down to zero. How are we going to do that? By taking away a portion of it each time. How are we going to figure out the portion? We're going to use the straight line method of amortization, where we take that discount or premium and we divide by the number of interest payments. So they got 900 here. Any questions on that? And here's that amortization table. Again, I'm not a big fan of the amortization table, but they're starting with 103,600. And every time they're taking out this $900 in this case, all the way down. That first one wouldn't be there because that's times zero, but all the way down, they're taking that amount out. If you were to add these up, it would total up to 3,600. That's the amount that you started out with in the unamortized premium. And the way they get this carrying value, I put it in your notes earlier, is the face plus the premium. That's a lot of material to absorb, and we haven't even got our hands dirty yet. So our next approach, once I stop for questions, is going to be to jump in, get our hands dirty, get some real life experience with some numbers, with our calculators, and get busy. So any questions on any of the theory that you heard?
Yes, Professor. So just to clarify, from my understanding, they're using the premium to kind of lower the cost of the interest expense that they have to incur. Therefore, kind of like taking the money that they've already paid because it's marketed at a higher rate, or the contract rate is higher than the market value, so that they're using the extra money they get to kind of help pay the interest payments, and then the opposite occurs when the market value is higher, right?
Right, you got it. You said it
All right.
exactly right. So you got it. So whatever way you want to think about it in your head, the mirror, you got it right. So keep that. There will be questions that ask you, what's the definition of a discount? And you need to know, oh, is that where the stated rate is higher than the market rate, or is that where the market rate's higher than the stated rate? So I go back to my head of thinking about the car example, where what happens if I'm selling my car for too little, then all of a sudden everyone's going to want it, right? So whatever you use to walk yourself through the mental instances of what happens, go for it, because what you just repeated back is perfect. Okay, let's jump into our Excel spreadsheet, because I believe that this is the best way to get practice with this. And as you know, I devote at least an hour's worth of class time to this. Today, our lecture was pretty substantial because it's a pretty tough chapter. And it's also a whole nother thing to understand this from the investor's perspective. And they took that out of your chapter. They actually watered down this chapter compared to what the book used to be like. I'm a little bit disappointed, not because I want you guys to have any more difficulty, but to me, it's important that you understand bonds also from an investing standpoint, because all of you in here, when you have your career jobs, you're going to have extra money set aside. And it's important that we start to think about retiring, and can we put a certain amount aside? And one of the options out there is bonds. And as I get older and my working life starts to go down, my goal is to take more money out of the stocks and the other, what I call riskier investments, and slowly move it over, maybe even looking at bonds with specific interest dates so that I can have a cash flow that's guaranteed in my later years, maybe even monthly if I structure it right. So it's too bad that they took that off, but just know that you guys do have personal finance classes, which I would encourage all of you to sign up for. Finance 125 is specifically the personal finance class. And also, if you're interested in retirement planning, and I know when I was 20 years old, you could have not paid me to even think about retirement because I was too busy being a struggling student, just trying to make it through the week on groceries. So I get that mentality. But being educated now, because you're starting your education, knowing that Social Security is not in a good place right now, you might want to think about, it's a 9-week class, the retirement planning. You might think about wanting to take a retirement planning class now, because even if you could set aside that $20 or $50, it can grow and grow and grow, and you will be amazed at how fast that can take place if you take a hands-off approach, which is I'm not going to touch that money until I hit whatever retirement age you are going for. All right, on January 1st, Boston Enterprises issues bonds that have a par value. Okay, that number is always important. I call it face, but par value means the same. So on its face, we got a $3,400 bond. That's always what the cash interest is based on. This is a 20-year term. Okay, I went in right before class started and just wrote these out so I wouldn't have to fumble around with typing in front of you. And it pays 9%. And it's very important to understand how often. Now let me format this as a percent so that will show up. 9%, and it says semi-annually. So semi-annually means 2 times a year. So because this is going to become important if we do any amortizations, how many interest payments will that be? Let's see. I would put this on every bond problem I do. I would put these things at the top, just so you don't have to keep going back and forth. The face, 3,400,000. The term, this is a 20-year bond. So if you're wondering, where am I getting these things from? The interest rate is stamped on there. It's not going to change. It is stamped on there. And these pay interest twice a year. So if these are 20-year bonds, that means there's going to be 40 interest payments. How did I get 40? 20 years times 2 times a year. That's how I got 40. The bonds are sold at par. Okay, that never happens except in a textbook. What that means is our bond is stamped 9%. And on the day it floats, on the day it issues, the market's also exactly 9%. Now, remember, bonds are issued either in 8th or in 12th, depending on what type of bond it is. So the chance that it's exactly 9% on the day that we issue it is slim to none. But in the book, it happens. Number one, how much interest will the issuer pay in cash to the bondholders every 6 months? Okay, let's do that first. So the interest paid every 6 months in cash would be our formula, principal times rate times time. Okay, so this is where I'm looking at the facts I wrote down. I don't have to look back and forth every time. 3,400,000 times 9% times, I use 6/12. Your book uses 1/2. It's the same thing, so it doesn't matter what you do. It's usually easiest if you go backwards on your calculator, although you don't have to. So let me get my calculator out so I don't have to type all that stuff in on Excel. I hope you guys are doing it with me, both Thamir and Julie, anybody else in the room. I got 153,000 as the semi-annual interest payment. Okay, so that's our first answer for number one. Let me stop. Give you guys a chance to do that on your own, to check it out. Then they're going to ask us for some other journal entries. Okay, remember, because this was sold at par, there is no discount or premium on this one. Okay, so someplace in your notes, I would write that. In fact, I'll write it right here. Because the bond was issued at par, which doesn't happen in real life, there is no discount or premium on this example. All right, so number 2 says they want you to do 3 journal entries. So I'm going to write them down. They want the issuance, and then they want the first interest payment and the second interest payment. Well, all the interest payments are going to be the same. So I'm not quite sure why they asked you for the first and second interest payment, but again, it's a textbook, so we'll go with it. So January 1st was the issuance. So let me write in my date, January 1st. And remember what a bond is. It is a way to finance a corporation through the sale of debt securities, as opposed to equity financing in our next chapter, which is the sale of stock through equity offerings. Okay, so this is what happens. The cash goes up and the liability goes up. By how much? For the amount of the face or the par value. $3,400,000. So that would be our issuance of bond at par value. Then 2 times during the year, they pay out interest. 6 months later would be June 30th. And the second interest payment would be another 6 months later. That would be December 31st. So let me get those dates down. Now, we already calculated what the cash interest payment was. I just circled it. And so this one's relatively easy. It would just be interest expense. I think your book uses actually bond interest expense and cash. For that yellow number, I will make it yellow so you can see where it came from. For the $153,000. And I'm just going to put down here that it would be the same. Okay, we don't have to write it again. It's going to be exactly the same. So that's number 2. Any questions on that? So that would be A, B, and C specifically. Let me make this red so it shows up. Okay, if I don't hear any questions, I'm going to keep going. If I need to wait, just speak up. Okay, let's go look at the second part of this problem. Number 3 says, what would the journal entry be for issuance, assuming that the bonds are issued at 98? Okay, what the heck does that mean? That is a percentage of their face. Bonds are quoted as a percentage of their face. So when you see that a bond sold at 98, it means that they got 98% of the face or par value. That implies that there is a discount. Why would there be a discount? Because your bond wasn't priced properly, not intentionally, but just because of the time differential that happens between the time a bond is approved and printed and the time it's actually sold. And so the way that the market is going to adjust for that is you're going to get less money than you thought you were going to get. What do we do? How does the market, how do accountants account for that? We use a discount account where we're going to save that other 2% in the discount account. And then little by little, we're going to transfer it to interest expense through the amortization process. And I know that is not an easy topic. I think what I might do here is just snip this little number 3 here, so I don't have to keep driving the screen up and down on you guys. Let me get that, edit, copy. And let me just go down to the bottom here so I don't have to keep flipping the screen. I know that drives you crazy. And I was reminded in a training session that I went to with the Cal CPA yesterday, how annoying it is when the instructor keeps flipping the screen on you. So it's just a reminder to me. Okay, so if this bond is issued at 98%, the issue price then, let's calculate that, would be the face or the par, the words are used interchangeably, times the 98%. Okay, and let me change Excel to be a percent so that shows up properly. So let's put that face value in, 3,400,000, and let's multiply it by 98%. And that will be the amount of cash received. Okay, so far as I kind of construct this journal entry, here's what happened. I got cash, not at the full amount of the bond because the bond was not priced appropriately, not intentionally, just a market force. However, I owe the whole face value back whenever this bond matures, $3,400,000. So what's it going to take to balance this out? In this case, let me make it a different color. In this case, there is going to be a discount. For how much? For the difference between those two. for whatever 3,400,000 minus 3,332,000. Now let me write that out over here neatly so you don't have to sit there and wonder, how did she come up with that? We have the face, okay, 3,400,000, but we got less than that. We got only 98% of that. So I'm going to write that out here as a reminder out to the side. We got only 98% of that. We just computed it. So you see the calculation next to it. That means that the difference between those two, in this case, the proceeds were lower. That is the definition of a discount. Okay, what are we going to do with that discount? It's going to sit in this T account. And I don't think they asked us to do the other journal entries on this problem, but little by little, we're going to amortize it so that by the time the bond is paid off, it's going to be zero. So here's this discount on bond right now, sitting here with a debit balance of 68,000. Every time we make an interest payment, we're going to amortize this. Okay, it did not ask you to compute this, but I'm going to, in the interest of learning and demonstrating this chapter, I am going to demonstrate this. How many interest payments were they making? Okay, we wrote that up at the top somewhere, and sorry, I have to scroll. 40. It was a 20-year bond, and we were making 2 interest payments a year. That would be 40 interest payments. So we would take 68,000 and we would divide by 40. And every time we made a cash interest payment, we'd also include this discount on bonds. So I'm going to press enter in a second. I wanted you to get that into your notes on how we came up with that. This problem did not ask you to do this. This problem just asked you for the issuance journal entry that we just did. This is 3A, by the way. But in the interest of learning, that amount would be $1,700. And if we did that every time we made a payment, or 40 times over the course of the year, or over the course of the life of the bond, by the time we hit the maturity value 20 years down the line, we would have zero left in the discount. That's the purpose, to take that adjustment to the bond price and amortize it over the life of the bond. In this case, again, they didn't ask us, we would be making a journal entry for a $1,700 amortization to the discount on bond account. Let me stop. I haven't done the 102 yet, but any questions on 3A? Okay, then as I bring that up here, let's do 3B. Where this time it is selling above the face. So remember, in this case, the face or the par is still 3,400,000. Nothing will change that. That's stamped on there. But this time, because of external market factors, we're able to sell this for 102%. And again, I have to change that cell to a percent so it shows up. So when you do that on your calculator, when you take 3,400 and you multiply it by 102%, here's your cash now. This is cash received. You got above the par value because the bond was not priced appropriately. You got 3,468,000. So let me record that. That's going to be my cash account, and I'll make it green so you can see how it ties in. Remember, my bond payable is still sitting at the full face value. That doesn't change. It's stamped on there. It's an IOU for 3.4 million. So what is it going to take this time to balance this out? It's going to take a credit for the difference. That difference is called premium on bonds payable. And you could probably see that it will be, for the difference between these two, 68,000. Let me show you what a premium T account would look like. That's all the problem wanted, but I'm taking this one step further in the interest of educating you and learning this chapter. Here's this premium on bond. Unlike the discount, it has a credit balance of $68,000. And if we amortize it every single time we make an interest payment, we would be doing 40 payments of $1,700, just like before. That would be the 68,000 divided by the 40 interest payments. If we did that 40 times, we would have a zero sitting in that premium account. So the whole purpose of this discount and premium is to adjust the market interest rates on our books, either as an additional expense if it's a discount, or as a reduction to the expense if it's a premium. It is not an easy chapter. You guys are going to have to work, and I would encourage you to do more homework than what I assigned, unless you feel 100% comfortable at the end of the homework. Questions on that? Okay, let's go take a look at 10.4 then. And if you have to leave class, someone already told me they needed to leave. You're more than welcome to do that whenever you have to. All right, Tonneau Company issues bonds with a par value. So I always write the par down of 180,000. They do it on 1/1 at the start of the year. The bonds contract rate, its stated rate, the stamped rate is 8%. Let me put a percentage designation in there. And interest is paid semi-annually on June 30th and December 31st. I'm going to put that in here so I don't screw this up, because if you don't read that carefully, that'll do your whole problem. So semi-annually. And it says the bond mature in 3 years. And because it's semi-annually, that would be 6 periods. 6, I'm going to call that interest payments. How'd I get that? 3-year bond, 2 payments a year. That's what semi-annually means. That means we're going to be paying interest 6 times. The annual market rate is 10%. And so because those were selling above what our bond was selling at, these sold at a discount. In other words, because Wall Street was willing to pay more on their bonds than we were. Remember, ours is stamped 8, theirs is stamped 10. So again, here's our stamped rate, 8%. And out here is Wall Street's 10%. I don't think that shows up on your camera. That means that our bonds are going to sell for less. The market adjusted it. And because of that, they only got 178.62. Okay, well, here's what that looks like. The face of this, we said, was 180,000, but the proceeds were less. We only got 178.62. That means that I have a discount that I need to amortize for the difference. Okay, so I haven't even read the instructions on what they want us to do, but I know just based on the first set of facts that I have a discount up here that needs to be amortized in the amount of $91.38. Okay, I'm going to make a T account just to kind of visualize what's going on. In fact, I'll do it right here. Let's make a little T account for this discount. This helps me, shoot, I pushed a button I didn't mean to push. Hold on. The visual for me tells a lot and helps me remember the journal entry. So I would encourage you to think about making a T account on these. T accounts are very useful. Here's my discount, and it's sitting there at $91.38. So what's going to happen with this is every time an interest payment is made, I need to reduce this discount account. By how much? Whatever 9138 is divided by 6. Where'd that 6 come from? 3-year bond, interest twice a year, 6 interest periods. When I do that, every time I make an interest payment, I'm going to include an additional interest expense of $15.23. That's what we call straight line amortization. It is not GAAP acceptable unless there's no material difference from the real method that we're forced to use, the effective interest method of amortization. That's for a later accounting class for accounting majors only. So if you are an accounting major, read the appendix that talks about it. If you're not an accounting major, don't trouble yourself with it. All right, let's go back and answer these questions, because right now I've just kind of set up the picture of what's going on, and sometimes timelines might help you. So here's what happens. We get 180,000 now up front, and there's a total of 3 years, year 1, year 2, year 3, but we're paying interest every 6 months. So every 6 months, there is going to be an interest payment. And then when it gets to the end of the life, that's when the principal is going to be repaid. And I'm writing sideways, I apologize. So for some people, it helps to draw a picture. Okay, 1, what is the discount on these bonds at issuance? Okay, we calculated that. So there's number 1. Let me make that red so it shows up. We already calculated that. Number 2, how much bond interest expense will be recognized over the life of these bonds? Okay, well, let's calculate our cash interest expense right now. Every time we make a payment, we're going to do this calculation that doesn't change over the life. Okay, so the principal is 180,000. The rate they gave us is 8%. And the time is for half a year. So let's go do that cash payment. I'm going to let Excel do it. 180,000 times 8% times half, or 6/12. There's the cash payment. In addition to that, we have this 1523 amortization that's going to add to the interest. We already calculated that. It's going to be 1523. So when I add this up, this will be the total interest expense for 1 period. I'm going to move that over so it will stay on my screen. Let's add that up. 8723 is how much it is for 1 period. And remember how many periods we had? We had 6. So if I multiply this by 6 periods, I'll have the total interest expense. There's always more than one way to calculate this. I think this is the easiest way to compute it. So this is the way I'm showing you. Let me do that on my calculator. 8723 times 6. I get 52,338 over the life of the bond. Okay, that's the answer to number 2. Number 3, I'm not a fan of, but we'll do it so you can do your homework. Number 3 is they want a straight line amortization table. Now, I do my interest tables usually different. I'm going to try really hard to follow what the book does. So there are 6 payments. We know that. So let me get my period in there. I'm going to start with period 0, and I'm going to go down to 6. I'll let the computer fill that in. So put your periods down. They probably will ask you to put dates down. That first date was 1/1 of 21. That's the issuance date. That's period 0. So let me write that down. The other dates, and I'll have to make this wider to show, the other days are the interest payments. So what that would look like is 6/30 of the first year and 12/31 of the first year, and then 6/30 of the second year, and so forth. I probably don't need to fill all those in for you, but. And then 6/30 of the third year and 12/31. By that time, the bond will be paid off. Okay, so an amortization table has the periods. It has the date. I'm going to leave an extra column in here because I think it might be helpful. But what they're going to have you do on the test is put in unamortized, or on the homework, I should say, unamortized discount. Okay, you could go look at your T account. And what we started with in there was 91.38. Remember, the goal is to bring that down to 0. And the carrying value for a bond that has a discount, I'm going to write in words what it is. It's the face less the discount. So we started this bond off at having a carrying value equal to the proceeds right now. That's what's sitting in our bonds account. Okay, how do you do this table? This is where I think this other one might come in handy. I'm going to put the amortization dollar amount. We calculated that on our table. Every single time a payment's made, we're going to drop this amortization amount by 1523. That stays static all the way down. Let me see if Excel will increase that or keep it static. Keep it static. So basically, this is just a simple math problem, right? So here's what I mean. 91.38 minus 1523. Now you're sitting at that one. And then 76.15 minus 1523, it's going to go all the way down to 0. And if you guys know how to use formulas in Excel, you'll be able to do it much quicker. I don't want to throw anybody for a loop, so I'm manually doing it. And if we did this right, you'll notice that we get 0 in there. And then the carrying value would be what it is right now. Let's see, we want this to approach face. So you could do it several ways. I'll go ahead and use the face minus the discount here. So that way I can do the face value is always 180,000 minus, I'll use this cell. Okay, and then you'll notice that by the time we're done, this has to match the face value. Okay, so I did a formula in the interest of time there, but you could do it manually every single time. The goal here is to see that by the end of the life, the carrying value equals the face. That's the goal. So for discounts, the goal is to bring the carrying value up. For premiums, the goal will be to bring the carrying value down. I think we answered everything on that. Any questions? It's a tough chapter. I do want to go do at least one more that deals with the premium. So we'll do one last example here, and then I'll send you the answer for these B problems. But I did want to tackle a premium before you guys leave me here. So let me give you a chance to read it over. I'm giving myself a chance to pull up the work I did this morning. It says Quattro Company issues bonds again on the first day of the year. We're making this as easy as we can because this is a survey class with the par value of 400. Okay, let me write that down. The bond's annual contract rate is 13%. Let me write that down, 13%. And whoops, I wrote that in the wrong cell. The stated interest rate is 13%. Let me move that down. And net interest is paid twice a year. I'm going to definitely write that down or I'll blow my calculation. Semi-annual interest. The bonds mature in 3 years. So once again, I'm going to go to the extra step and write in 6 payments. That's going to become important when we do our amortization. So I haven't even read the rest of the problem yet. I'm just setting myself up by writing down what the face was, what the term is, and what the interest rate is, and then asking myself up front, because I know I'm going to have an amortization here over 6 periods. Now you'll notice, since the market rate was 12%, and our bonds were offering 13, our bonds were offering higher than what everybody else was offering. Lots of people are going to stand in line to buy our bond or to buy this car that we're offering. So the price, the market is going to adjust it up. And it did, because it sold it for $409,850. So out here, I'm looking at my proceeds, and they gave it to us. There is a way to calculate that in the appendix. You guys are not responsible for it as just regular business majors. But if you're an accounting major, read the appendix on how to calculate the proceeds as far as exactly what that bond's going to sell for. I'm going to compare that to my face of 400,000. And in this case, you can see that I got above the face value. That is the definition of a premium. So this is how much is sitting in my premium account. It is the opposite of a discount. So if our discount had a debit balance, our premium is going to have a credit balance. So I'm just going to set this up visually because that helps me with the journal entries. Here's my premium. It has a normal credit balance. So here's this $98.50 sitting out there on 1/1 when we sold that. So every 6 months, every interest payment, we are going to amortize that premium. Again, I'm just giving you a visual picture of what's going on. So before I even read exactly what they want us to do on this, I'm going to take, let me write it down in words first. I'm going to take that $98.50 that's sitting in there, and I'm going to divide by 6 payments because that's how many interest payments I'm making. So $98.50 divided by 6. Go ahead and calculate that. I don't think they're going to have us do any rounding. I got 1642. I was looking to see, I hope they don't use pennies in this. So let me wait for a second. Now, what does a premium do? Since we got more money up front, that premium is going to be used to reduce the interest expense. I'm such a bad typer. Reduce the interest expense over the life of the bond. So every time we make an interest payment, our interest expense is going to be reduced by 1642. Let's go out here and show you what I mean. Our cash interest payment, forget for a second about any kind of interest amortization. Let's take a look at our principal times the rate times the time. This is always the stated interest rate. It's what's stamped on your bond. It's what you are legally responsible to pay every 6 months. Okay, so 400,000 times 13% times 6/12 or 1/2. You decide how you want to remember that. Let's see, I have something in here that Excel does not like. 26,000 is what I got. That is the cash interest payment. Okay, now, let me do that on my calculator just to make sure, since that Excel gave me a little error.
I got the same answer, Professor.
Thank you. That helps me, Julie. Thank you. All right. So here's how I would do this, and then I'll show you what Connect is going to do. I would do this in 2 journal entries because to me, this makes more sense mentally. Connect is going to combine them. So I'm going to show you the 2 journal entries and then we'll combine them in Connect. So let me, for lack of a better word, call this my way. You are totally free to think about this however you want. My way is going to first do the cash interest expense. So bond interest expense is going to be 26,000. We just calculated that. And that's going to be a credit to cash, 26,000. And that is going to be to record the cash interest payment every 6 months. The second entry I'm going to make is to deal with this premium amortization. You can visually see on my T account that I'm going to debit the premium to get rid of a portion of that each time I make the interest payment. So here's how I would do the second part. I would have the premium, and the book probably uses premium on bonds payable, but premium's good enough. I'm going to debit that as I showed you for 1642. Let me put some color in there so you can see where that's coming from. Remember, this is not a cash item. This is the way that we are taking that market factor of this thing called a premium and spreading it out over the life of the bond. Because we got more money up front, we're reducing our future interest expense by a little bit each time, specifically by 1642. That looks odd because it's a credit to interest expense. So here's what Connect does. Connect takes those 2 journal entries and combines it into one. And again, I don't even know if they asked us for this, but again, I'm teaching, so I'm always going to show you more than less. If we were asked to do the journal entry for this payment, this is what it would look like. I'm combining these 2. I'm going to have a debit to bond interest expense. Remember, these 2 offset. So let me color these. I had a $26,000 debit and a 1642 credit, and these should have the same name. So let me go change that to bond interest expense. So my bond interest expense is going to be those 2 yellow amounts offset. So let me go pop that in. And then I'm also going to debit that premium like you see in blue over there. I'm going to debit that premium to make it go down by 1642. And of course, the cash, the hard cash that's going out has to be that $26,000 that we computed up here. And that's what Connect does. Connect combines them into one journal entry. So let me put Connect's summarized one journal entry. Okay, that's what you're going to be doing on your homework. If it helps you like it helps me to think about these in 2 steps, you might want to do it first on a piece of paper and then combine them into one. So I'm going to go back now and read the problem. I did a bunch of extra things in the interest of teaching, so to help you learn. Let's go make sure we answer these questions that they ask us on this problem. What is the amount of the premium on these bonds at issuance? Okay, we answered that. So let me make that red. There's number 1. Number 2 says how much total bond interest expense will be recognized over the life. Okay, well, here's one entry. And these entries are the same over the life of the bond. So I think the easiest way to answer that is just to multiply this by the number of payments, which I think we said was 6. So there's lots of ways to calculate the total interest. But since we've lined it all up and we did extra work out here, I'm going to take that 24,358 and multiply it by 6. And that will be the interest over the life. Now, there might be a little bit of a rounding issue, but I think your publisher should accommodate you on that one. So that is the total interest over the life. That would be number 2. Let's go back and make sure we answered everything. So first one, they asked us, what was the premium? Got it. Second one, they asked us, what's the interest over the life? We had 1 payment's worth of interest expense there. So we just multiplied it by 6. To me, that's the easiest. Let's see what the last one says. An amortization table. I hate doing those things. What I might do is see if I can copy or reference this other part. Let's see if this lets me do it, because this was also 6 payments. In the interest of time here, let's go see if we can compute these. Yes. I don't know if the years are the same. It doesn't matter. So I do want to be able to show you a premium one. So we got the period. We have the dates. I'm going to leave a column here. I'm going to call it premium amortized. I'm going to leave that blank because your book does not have that column in it. What your book has is unamortized premium and carrying value. Remember, carrying value for a premium is the face plus the premium. Okay, so we start here with an unamortized premium. Let me go grab our little diagram here of $98.50. That's what was sitting in that account. And every time we make an interest payment, we already said that we're going to take this down by $16.42. Okay, this part is not in your book. They just make a math calculation each time. I'm doing it in the interest of clarifying where the number's coming from. So we're going to take that $98.50 and we're going to take it off going all the way down. This time I may use a formula in the interest of time. I think if I grab that and drag it down, we'll have it. Nope. So I'll have to go fill it in. There's probably a circular reference in there. So you guys would fill this down. This would be 1642 all the way down. So let me do this. I'll fix that other one in a second, that other column. And then this unamortized premium would be the 80, the top one, less that 1642. What happened on my table? So it's a thing that Excel does when they copy numbers. It's not even worth explaining. Let me just go fix it. There we go. And then all the way down, we should be taking that 8208, subtracting out the unamortized premium. This should approach 0. This is a little bit off because of rounding, so that's fine. And then the carrying value here would be the face plus the premium. The face of this, I'll have to go look, was 400,000. So for our first one, I'll put it in parentheses. This would be 400,000 plus that 98.50. Let me go put that in there. And then you would do that all the way down. The goal of the carrying value is to approach the face. There's another way of doing this, but I don't want to confuse you by it. So this would come down every time. Okay, I'll let you work out the math mechanics. Let me at least give you some answers to compare to. I don't think I did that right. And go ahead and we'll see if we hit something close to the face by the time we're done. And we do. Remember, our face was 400,000 and this is due to rounding. The statement, the math is right here. So each time you would do the face plus the premium. I'll give you one more example to follow. Plus 8208, you would do that all the way down. And the goal is by the time you get to the last bottom right-hand corner there, that should approach or should approximate the face. Your Connect has rounding features added to it, or tolerances, I guess is another word that the computer will accept. So you should not face any rounding errors. And that is the toughest chapter I think we've had to date, without a doubt. It's not something that you see every day. And so it's unlike, cars that you buy and you can understand what depreciation is because we all have cars around us. Bonds are a little bit different in that they are a financial interest. In this case, it is debt. So again, we're talking about corporate financing. Way back at the start of the chapter, we said one option for a corporation to get money in, or an influx of money in, is by selling debt securities. Those are what we call bonds. The second way is through equity financing, the sale of stock. That's in the next chapter. So the last thing that we'll be talking about in this chapter in our next class period will be another way that a company can get money is by taking out a traditional installment loan. Those are the type of loans that you and I have on our cars, most likely. That includes principal and interest, unlike these term bonds that we're looking at. That will be the focus of our next class.